Hi everyone, welcome to YX Insights. This is Yimin. Today is Friday, June 13th, before the market open. We're going to first go through a quick recap of the CPI data from Wednesday, and then we are going to have a close look at the current market fundamentals for SPY, the S&P 500. We're going to look at the FOMC preview for next week, as well as the broader bond market. And then before moving on to the chart analysis for the usual tickers, including SPY, QQQ, TLT, US oil, Bitcoin, Max 7 stocks, gold, and SOXX. So let's begin. On Wednesday, the CPI data came in below expectation. If we look at this trend from January onwards, what we see is that inflation started to really calm down. Even though core CPI is sticky at 2.8% year on year, and it's been so for the past 3 months, this was still better than what the market expected today, which is 2.9%. So overall, we're moving towards the right direction. And if you look at the headline CPI of 2.3, 2.4, it's actually not that far away from the Fed's target of 2%. Although the Fed's target of 2% is on the PCE level rather than CPI. And what we're seeing is that we have robust jobs market with non-farm payrolls exceeding 100K new jobs added every single month for the past 7 months. And we have CPI or inflation coming down towards the Fed's target. And we've not yet seen the impact of tariffs on inflation as well. So we are at a spot where exactly the Fed wants and what the market really wants, a benign growth environment, and what the Main Street would want, robust jobs and earnings with low inflation. But there is still macro uncertainty looming at large in terms of how much tariffs are eventually going to be implemented, especially after 90-day pause in April. That uncertainty should command a higher risk premium for risk assets. Investors should be looking to charge more, looking for more money on their return to justify the additional risk taken on given the macroeconomic backdrop. What we're seeing right now is that the stock market has reapproached its all-time highs. SPY is trading at EV over sales ratio of 3.6 times for the next 12 months, and a PE of 22.6 times. So both of those ratios are much closer to their 2 standard deviation highs in the past 10 years than their mean ratio. So as we approach the all-time high here, investors got to ask themselves again whether this is investable multiple, given all the uncertainties that have been introduced that could potentially damage corporate earnings in the next 12 months. Historically speaking, when you are investing at multiples such as 22 times, 24 times, then forward-looking 10-year returns tend to underperform compared to if you were investing at a PE multiple of, let's say, 19 or even 14 back in 2023. So investors are now, again, looking across to the bond market and say, okay, 10-year is yielding 4.5%. Is it worthwhile actually still risking my assets in stocks versus just parking it safely with bonds? Plus the interest they get back each year. So in that sense, for long-term holders, the bond market probably looks more attractive right now, given where the stock market valuation is. So that's something we need to be aware of in the long term. In the short term, of course, the market can still keep rallying to new all-time highs and going past it. But from a long-term perspective, the risk reward starts to diminishing compared to mid-April. Looking at the seasonality for SPY, so June is typically a weak month. We expect a pullback in June, which we haven't yet got. But looking at the past 10 years, but you can look back 15 years and 20 years, June has always been quite a weak period compared to, let's say, October to mid-November. So if the market at the all-time high now wants to take a breather and pull back right now, June is actually the perfect time to do so. A lot of traders, investors going away on the summer holidays soon, so they might be winding down their positionings as well in the short term until they come back. So we are expecting higher market volatility, at least in the coming 8 weeks as people go on holidays and liquidity is thin. Looking at where SPY is, how it trades with the dollar. So the orange line here is the inverse dollar, and SPY is in blue. What we've seen is that with a 6-day lead, which is basically 3 months, there is quite a big positive relationship between weaker dollar versus SPY. So when dollar gets stronger, which means this orange line goes lower because of the inverse, SPY also goes lower 60 days later. And when dollar goes weaker, which is the orange line going up, SPY moves up. Why is that? It's because most of the global collateral that people use for liquidity purposes is quoted in dollars. So a stronger dollar actually diminishes the collateral value, which generally speaking reduces the liquidity pool. So there's less money going around into the risk asset markets. You can see that in Bitcoin and risk stocks like Tesla, but this relationship also seems to hold for stocks generally. So we're at this period where the dollar got stronger about 60 days ago, and we could be expecting this modest pullback here. And we could still have an all-time high after, but I think the risk reward right now for chasing the market in a new trade, if you didn't have a trade on, is not really appetizing. And then looking ahead to the FOMC, the market currently prices 85 basis points before June next year. What that means is that it's a coin toss between 3 or 4 cuts. It was actually just 3 cuts. Additional cuts has been priced in since the CPI data because inflation coming down means the Fed has room to move towards its more neutral interest rate value. So, but to be honest, the market has been yo-yoing between 3 and 4 cuts for some time now, so none of this is any surprise. In June, we see virtually no chance of a cut next week, and a very small chance of a cut in July. What the Fed really wants to do is they want to just wait and see as much data as possible to narrow down the potential impact of tariffs. So right now, the range of outcomes is very broad for how much tariffs will be implemented, with which trading partners, how much growth will get a hit, how much revenue it will drive in the fiscal spending on the fiscal side, and all of that is up in the air. And especially regarding inflation, is it going to be one-off price increase, therefore one-off inflationary impact, but not sustained going long term, or is it going to be more sustained if the tariff policy is on a staggered basis? So with all of these questions and answers, Powell really doesn't want to do anything, and he's unrelenting to Trump's pressure because he's only got another 1 year left before his term, and he doesn't want to ruin his legacy by being perceived as weak, not doing the right thing to protect inflation pressure versus catering to Trump's request. So looking at yields, this chart is a Fed liquidity versus the 30-year bond yield, but the yield is actually quoted in reverse. So you will see negative figures here. The reason I've done this is because higher Fed liquidity theoretically is better for bond holders. There's more liquidity going around, therefore bond prices go up and yields come down. Therefore, an inverse relationship. So what we see is a roughly 15-day lead for the Fed liquidity here. Coincide. So the Fed liquidity has been improving since May, whereas the bond yield, the 30-year bond yield, has only turned around about 3 weeks later. So what we are expecting is that as the Fed liquidity improves, mostly due to the Treasury general account drawdown, yields could potentially move lower. So this is the inverse. So this moving higher is yields moving lower in the interim. So right now, the Fed liquidity seems to be the leading factor here, and we'll just follow this for now. And as we can see that TGA, which is the Treasury General Account, that's the US Treasury's bank balance with the Fed, has been coming down since April. What does that mean? It means the Treasury is issuing less debt than the money it spends. And the fact that the Treasury spends money is a good thing for liquidity. It's spending money into the real economy. Money is moving from this TGA bank account that's holding money into the real economy and therefore into the bank reserves, into the likes of JP Morgan, Wells Fargo bank reserves, which can then move into risk assets investing or the bond market generally. So TGA coming down has helped the rally in the past 2 months. And then finally, before we move on to the charts, we'll look at YXI signals. These are proprietary machine learning models that produce a 1 or 0 signal each day for all of these tickers on the screen. 1 means the machine prefers the position to be on, it's risk on, and 0 means for this particular ticker, it doesn't want to hold, buy or hold this asset, it prefers cash instead. And what we've seen is that up to today, all of the risk assets received 1 and bonds received 0. So the machine didn't really like bonds and didn't like bonds for a while. And today, the machine has turned around and said, actually, okay, we can buy some bonds now, expecting yields to go lower. And of course, all of the other tickers are unchanged for now. So given the robust market rally we've seen the past 2 weeks, that's not really that surprising that the machine thinks we're risk on. And I think it's very often we have this human urge for mean reversion to say, okay, we must have a pullback, but the machine is much more objective in reading the macro factors that influence the individual asset prices and deducing whether the environment we're in is benign for that asset price. And this is the performance of machine learning models since the launch dates. So I've launched them as different dates. So you have to kind of proportionately read across how well they've done in that given period. For now, Bitcoin nearly 30%, Tesla nearly 30%, even after giving back some of the rally before the Trump-Elon Musk drama. And PLTR is up 15% since we launched mid-May. And I think the one I've been most impressed about personally is the Palantir, because Palantir was already near or at the all-time high back in mid-May. It just felt like it couldn't push on. Like we must have a pullback, but still managed to return 15% in just 1 month. And the machine has correctly deduced that environment to be right for PLTR in this time. And I think if I was purely based on my technicals, I would not have bought PLTR just based on the technical read, because the risk reward felt thin, whereas the machine doesn't really care about all that, and actually says PLTR is a buy. And the machine has been probably more right than technical analysis so far. So SPY, we're very close to the 1.382 extension of this wave 1, which puts SPY a decidedly bullish path. What that means is that I'm not expecting a new low from this point onwards. We could be moving in a wave 4 pullback, but not something that substantially breaks this low or even the wave 2 low, I would say. So I think we are in a decidedly bullish path. We will see an all-time high, but that could potentially come after a wave 4 pullback first. Just zooming out slightly, what we're seeing is that there's a heavy volume accumulation over here in the 588 to 595 level. This narrow range has seen the most volume since this crash. But actually, if you just zoom out, you can see this has been a very well traded band. So there is some gravity around this. The market could pull back to here as the first test in wave 4. But there's also the 200-day moving average underneath for support. So I think here is the first support, and moving to 577 is the second support before we get a wave 5. And I think this wave 5 could really end right at this long-term resistance line. I wouldn't say long-term, the resistance line that used to be support since September. I think that could be the final destination of this initial 5-wave sub. It doesn't mean I think the market is done then. It just means after this 5th wave, I'm expecting a deeper pullback than this wave 4 for a high degree wave 2, for example. QQQ, the QQQ price action has been more advanced than SPY, both in terms of this level relative to wave 1. So the wave 3 is already much higher than the 1.382 extension of this wave 1, and it's hitting this resistance line right on the nose. This line again is the support that that the market found between September and February, broke down. We had a crash and a V-shaped recovery, and now we're back here. So that is the current resistance that QQQ is struggling to break through. I do think there's a chance we will get the wave 4 now. First, retesting this heavily traded volume area at 520, and then secondly, the 200-day EMA, as well as the 0.382 retrace of this wave 3 being the key levels of support for this wave 4. So given the depth of this wave 2, I don't actually expect this wave 4 to be extremely deep. The alternating principle of Elliott wave theory is that if you get deep wave 2, wave 4 tend to be shallow and vice versa. And that makes sense because here everyone's really skeptical of if this boom, if this is going to be a bull trap. You could get new lows. So a lot of people miss this train on the recovery. Whereas if we get a dip here, a lot of people who miss this recovery have FOMO and now buying the dip. So this could be quite a shallow pullback. USO, the oil chart is a bit messy right now. Today's rally pre-open has invalidated my previously bearish wave C expectation, and the previous bearish expectation really lined up well with our fundamental analysis as well in terms of supply and demand. A lot of supply coming to the market this year, but not a lot of demand from, for example, China. Because the rising tensions in the Middle East with Iraq and Israel and US, we're seeing a massive spike in oil here, which could be an extended wave 3 rally at the 1.764 extension of this wave 1. So this could be the beginning of a new bull trend, which renders my previous B wave expectation redundant. But because the situation is in great flux right now, we just need a bit more time to observe and deduct and deduce where we are in the next move. TLT, what we are seeing is a sharp rebound in bonds since the 22nd of May. And actually yesterday, the auction did go quite well as well. So this has followed the recent rebound in Fed liquidity. And we could have TLT challenging this 200-day moving average in the meantime. Does that invalidate my overall bearish outlook? I think not just yet. So the short-term technicals is pointing higher towards this 200-day moving average. But I think unless it really takes TLT out of this channel, the overall trend is still a bearish one. And of course, I could be wrong, like I was on oil previously. But I just need more evidence to be convinced that this is a sustained turnaround where yields are going lower sustainably. The Fed still hasn't said anything on the rate cutting front. They're being very patient. We're passing a one big beautiful bill that is going to increase the fiscal spending. So the fundamentals haven't really changed that much. It's just short-term momentum is carrying us towards this moving average, 200-day moving average. So that will be the real test here, whether we get a rejection or a breakout from here. So I'm watching and see and not moving my broader outlook just yet. On Bitcoin, what we've had is a wave 4 correction here and a breakout of this trend line, and then now a retest that just fell through. I think broadly speaking, I would expect this wave 4 to still hold. If we're looking at this relationship between the G5 M2 money supply and Bitcoin, the overall liquidity is still very favorable for Bitcoin with a 3-month lead. A lot of this is driven by outright printing of money in the M2, but also a weaker dollar in the past 90 days. So I think the current correction will be just a correction rather than the mark of a long-term top. I do think Bitcoin will move towards a wave 5 high. And I've marked this wave 5 high at 116 to 120K, which is the 1.382 inverse extension of this wave 4 here. GLD, gold has benefited from rising geopolitical tensions as a mark of safe haven. And we're actually very close to the all-time high again. This is a very low confidence read on whether we are in the wave B bounce and then therefore a wave C retrace. The bias in the short term after this breakout is on the upside, but I don't think the risk reward is really that strong for chasing gold after this rally from April. The PBOC, the People's Bank of China, has already slowed buying gold at those levels. And we're seeing outflows in ETFs in North America and in Europe. So it does feel like more like a creative rally at the moment. But let's play the devil's advocate and say, okay, this is a start of a new bull leg. How much can we rally from here? Potentially, we're looking at this range here where the next leg could be the 123% to 176% extension of this drop from April to May. So we're looking at a potential gain after day's close of anywhere between 5% to 7%. I think for me personally, that's not a lot of upside for chasing. And therefore, I'm still neutral at this level. And not to mention that this could still be a corrective rally and not take out the all-time high still. Apple, although I have got those bullish path mapped out still because our bullish thesis hasn't technically been invalidated, the fact that it's coiling in a very tight triangle all the way through to the near end is not a bullish sign because the broader market has been rallying and Apple is still coiling here sideways. If it wants to go up, if investors are bullish on this, Apple would have already broken out and moved towards this 200-day moving average and then wave 3 high already. The fact that it hasn't means the odds are shifting towards a more bearish path now. Now, I don't want to speculate on how that bearish path could look like just yet. I want to see a solid breakout below this trend line support, and then also this red dotted line, which is the wave 2 low. Once it breaks out, then we can probably deduce whether we're going to see a new wave C low, a large degree wave C low, or maybe this is just a deeper wave 2 pullback from here. But for now, I'm quite neutral and not very hopeful for on Apple. So Amazon, technically speaking, as the intraday high on Wednesday has just reached the 123% extension of this wave 4, inverse extension of this wave 4, and that suffices wave 5 length. But typically in the bull market, we do tend to see a bigger wave 5 here, which should take us above 220. For now, the risk reward is not that great for chasing this final mile, which may never come. So I'm actually just waiting to see whether it's going to test this 200-day moving average first, and whether wave A of a correction has begun. There should be a lot of support in this region around 200 because a lot of volume exchange hand here. So a lot of people this is a level a lot of people are going to be break even. Interested in dip buying, especially on the 200-day moving average. So I think on the bearish side, we could be holding here around 200 for the next support. Google, very similar. It has reached the 1.236 extension of this wave 4, the inverse extension, which suffices the all 5 waves. And we could be seeing the beginning of wave A. And I think breaking through this 200-day moving average will be very important in determining whether that wave A is in place. So if we break below this and challenge this wave 4, we could have wave A on our hands, and this all 5 waves are complete. Meta's wave 5 run has been more extended than others, hitting the 200% extension of this wave 4. So it more than suffices all the 5 waves up. I do expect a pullback from here, whether it's going to touch all the way down. I think it has to get through this volume profile here, around the 240 region, and then there's a gap down here. If it falls through 635, it will test this 600 quite quickly. Microsoft, every day I've been expecting the beginning of a wave 4 pullback. Every day it just grinds higher slowly but surely. And that does make me think that given the slow pace of this, the pullback could actually be quite rapid when it starts to happen. What we usually see is that when one side is very slowly grinding up, it just takes a lot of effort each day. On the downside, people get a little bit more anxious more fast because everyone's really expecting a pullback is due. It just doesn't happen. Psychologically, when the first sign of trouble comes, people tend to push their sell button quite quickly and lock in the gains. Looking at wave 4 could be the 0.382 to 0.5 retrace of wave 3, which coincides with the 200-day moving average, is a quite ideal supporting ground for this wave 4. So I think we can get down here into 420, 410 before making a final wave 5 high. So this is a preliminary placement. It could be much higher given where wave 3 has been. NVDA, the wave 5 has reached its initial target, could move a bit higher, but the risk reward chasing it is not really that great. So primarily, I'm waiting for this wave 4 pullback near the 200-day moving average. And I think while this is the first level it could hit, there is more support around the 118 region because of this volume profile. So actually, I would probably say that wave 4 could test the 118 to 124 area just below the 200-day moving average. But ultimately, I do expect one more wave 5 higher above the all-time high. Tesla is one chart that is not that easy to decipher. What we've had is a crash from December 2024 high near 480 all the way down to 200. So more than 50-60% drawdown. And it's shaken a lot of people out in this process, especially below the 200-day moving average. And since then, we've had a potentially what is a wave B corrective move. And we've been mapping out this wave B quite precisely every day almost since April. And it filled this wave B expectation at the end of May. And unlike assets like Bitcoin and other Max 7s, it's nowhere near the 480 high that it had back in December. So now, after this wave B high, we've had a small correction initially, and then followed by the Trump-Elon Musk drama that resulted in a much bigger 14% crash, which in market cap terms was the biggest in Tesla's history. That could be the first leg, wave A, of this broader wave C, bearish expectation. And wave C, broadly speaking, is at least 100% and up to 120% extension of this wave A from the height of wave B. And we've seen the market recovering some of that from the Elon Musk drama. Elon Musk has apologized. I think Trump doesn't really want to pursue it much further. But that high could actually just be a wave 2 bounce to the downside. So we could have had a wave 2 bounce, which landed around the 0.618 to 0.78 retrace of this wave 1. And now we could be looking at this wave 3 drop with the broader market correction that's about to come. There is the alternative bullish path, which I've drawn in red, which is this is wave A, this is wave 2 low, wave 3 into May, and then wave 4 correction from the Elon Musk drama. And this wave 4 is right on top of this wave 1, almost inch perfect. So people found support at the top of wave 1 to buy the dip here. And there is a chance that we are still having this possible wave 5 higher into 410 level. If that is the case, if we make past this, what I think is wave B high, and into this wave 5 level, then the bullish path could become the primary expectation, and we can invalidate this wave C. But until that happens, I would still expect this wave C, the 5 legs in wave C, to be the predominant probabilistic path ahead. So the way to think about this is not the market can go up or down, is that if Tesla cannot claim back this high, we are looking at new lows below this wave A in the immediate next wave 3 drop. But it can reclaim this high and reach this target we've set as our expectation above 400, then we will likely not have this new low at all, and we're just having a shallow pullback of a wave 2 and then get a broader bull market going for this large degree wave 5. So it's an if-then statement rather than, and yes, market can go up or down. Of course it can, but we need to prepare for both outcomes given the levels we're measuring. So that's how I think about Tesla. SOXX. SOXX had a pretty good run. It caught up with NVDA in terms of the Fibonacci levels. And I do think we're due a wave 4 pullback. The initial target is at 200 to 210. That's the 0.38 retrace of this wave 3, but it could move down all the way to 190 to 200 for a slightly deeper retrace. That is still above this wave 1 high. So that is possible. We just have to wait and watch how it tests this 200-day moving average. So thank you for joining me this week. We'll see you next week.